Let's talk about a ghost in the machine, a moment when the market's most watched fear gauge, the VIX, went completely haywire. Now, this wasn't just a number flashing on a screen, it was a crack in the very tool traders use to measure risk. So, what exactly happened? And what does it tell us about the plumbing of the financial world? Let's dig in.
So here it is, the whole mystery in a single chart. On August 5th, that blue line, the VIX index itself, just explodes, surging to crisis levels. But look at the red line. That represents VIX futures, which is where traders are betting volatility will be in a month. It barely flinched. The market's immediate fear gauge was screaming fire, but the forward-looking one was calm. That's not supposed to happen. So what on earth caused this bizarre disconnect? To solve this puzzle, we've got to go back to basics. We need to understand the tool itself. So for our first section, we're going to decode the fear gauge. What is the VIX and how does it actually work?
Okay, so at its core, the VIX is basically a forecast. It isn't measuring something that already happened. It's designed to capture the market's best guess of how much the S&P 500 is going to swing over the next 30 days. Think of it as a snapshot of anticipated choppiness.
In this quote from a Reddit user, it perfectly nails why the VIX has its famous nickname, the Fear Index. Just think about it, right? Markets tend to climb a staircase but fall out a window. Big, sudden moves are almost never to the upside. So when traders start expecting a lot of volatility, they're usually bracing for trouble.
And this leads us to its most famous characteristic. The VIX and the S&P 500 are like dance partners who almost always move in opposite directions. When the stock market's climbing and everyone's feeling good, the VIX is low. When the market plunges and panic starts to set in, the VIX spikes. It's this inverse relationship that makes it such a powerful indicator of how the market is feeling.
Now here's where it gets really interesting. The VIX isn't based on a survey or anyone's opinion. It's calculated using the real-time prices of S&P 500 options. You can think of these options as insurance policies. Traders buy puts to protect against a drop and calls to bet on a rise. The VIX specifically looks at what are called out-of-the-money options. These are the cheap lottery ticket-style policies for extreme events that probably won't happen. By seeing how much people are willing to pay for this long-shot insurance, the VIX creates its 30-day forecast.
So how do you actually read the number? Well, as a simple rule of thumb, a VIX below 20 suggests a stable, kind of low-stress market. But once it starts climbing above 30, that signals significant fear and uncertainty. And you want to keep that in mind, because on August 5th, the index briefly shot way above 60.
All right, with those fundamentals down, we can go back to the scene of the crime. Let's move on to Section 2 and really perform an autopsy on that bizarre spike.
And we're back to our central question. Was this a sudden, terrifying warning of an impending market crash, or was there something else going on under the hood of the index itself?
The first clue is in the ingredients. Think of the VIX like a recipe that uses a specific bucket of those options we just talked about. Well, on August 5th, the recipe changed in the middle of the day. If you look at these charts, you can see the range of options in that bucket actually narrowed. But, and this is the critical part, some new, extremely cheap protective bets, those deep lottery ticket put options, were suddenly added to the mix. And this chart right here, this is the smoking gun. It separates the total VIX value, in blue, from the contribution of that tiny handful of extreme puts, shown in green. I mean, look at that. That small green sliver suddenly shoots up, taking the entire index along for the ride. A few cheap bets on a catastrophe were suddenly having this massive, outsized impact on the final number.
So the takeaway here is crucial. It wasn't a crisis of confidence, it was a crisis of calculation. It was a mechanical quirk in the VIX's own methodology that allowed a few weird data points to totally warp the entire index. And that explains why the futures market stayed so calm. It knew this was a temporary, structural glitch, not genuine market-wide panic.
This one event really forces us to zoom out from one strange day on the charts and start asking bigger questions. So for Section 3, let's look at how volatility became such a central piece of the whole market ecosystem in the first place.
You know, the VIX has evolved a ton. It started back in '93, but the major overhaul came in 2003, creating the modern index we all know today. But the game really changed in 2004 and 2006 when futures and options were introduced. This completely transformed volatility from just a concept you watch into an asset class you can actively trade.
And for professionals, the VIX and all its related products are just indispensable now. They use it to gauge risk, to hedge their stock portfolios against crashes, and of course, to make pure speculative bets on which way volatility is headed next.
It's just deeply woven into the fabric of modern finance.
And if you want to see just how deep this rabbit hole goes, there's even a VVIX, literally the VIX of the VIX. It uses VIX options to measure the expected volatility of the VIX itself. It's a measure of uncertainty about uncertainty. When the VVIX is high, it means traders aren't even sure where the fear gauge itself is going. It's pretty wild.
So, after dissecting the index and this whole crazy anomaly, what's the bottom line? Let's break down what this all means in our final section.
The August 5th anomaly was really a masterclass in market structure. It taught us that the VIX, for all its power, is still a human-designed tool with potential flaws. It showed us that how an index is calculated is just as important as the final number. And critically, it proved that when you see a massive disconnect like this, you should probably look for a mechanical fault before you assume the world is ending.
And that leaves us with a final thought. We call the VIX a fear gauge, but maybe it's more like an engine light for the market's complex machinery. And when that light starts flashing erratically, it forces us to look under the hood. It's a reminder that markets aren't just about human psychology. They're also about the intricate and sometimes fragile plumbing that makes them all run.
This is not financial advice.